Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me to discuss COVID-19 and the REIT market and why it's an opportunity for semi-transparent active ETFs is Simon Goulet, co-founder of Blue Tractor Group. Simon, it's great to see you again. Welcome back to Trade Talks.
Jill, thank you. Good to see you again, and thank you for inviting us.
You got it. And the real estate investment trust or REIT space has been especially impacted by COVID-19 due to the flight from the cities and remote work. But REITs are not just about commercial and residential properties. So Simon, tell us more about the REIT space.
Absolutely. The REIT space actually is quite diversified, and you're right. Most people associate that with, hotels and malls, et cetera, but it really is much more expansive than that. But before I talk about the different sectors, just remind everybody what a REIT is. Really, it's an ownership. It's a security that provides ownership in a legal entity called the Real Estate Investment Trust that owns real property, real assets. So it allows you as an investor to have exposure to the real estate sector, but not actually having to physically buy your own properties, your own house, your own commercial strip mall, et cetera, et cetera. The benefit of a REIT is that almost 90% of its income has to be passed back to investors in the form of dividends. It's a great way to have current income. Typically, REITs are yielding 3 to 4%, which in this low yield environment is very, very attractive. Now, getting back to your first question, you're right. It's not just the hotels, the malls, et cetera. It's cell phone towers, it's industrial properties, it's timberlands, it's medical offices. It's a vast gamut of properties across the United States that allow you to access to and sort of diversify your portfolio in a very interesting asset class. But certainly, and of course, to paraphrase that expression, there's an app for it. Of course, there's an ETF for it. And there's been numerous ETFs that have been launched that allow investors to efficiently tap into the REIT market and enjoy the benefits that I mentioned, current income and diversification for their portfolios.
Why does active management serve the REIT sector better than passive?
It's an age-old question, right? Because certainly, some folks will argue that low-cost passive ETFs have done quite well in all market conditions, and that's it's hard to argue with performance. Think of VNQ, some of the larger ETFs, the REIT space. Over time, they've performed fairly well. They've kicked off nice current income to investors, but the problem is they're exposed to all the sectors I mentioned, and the fact of the matter now in COVID is that some sectors are being hurt. Obviously, with the flights to home working, no travel, people shopping online, sectors like hotels have been hurt, malls have been hurt. So if your large cap or large diversified ETF is exposed to those sectors, that will drag down performance. And we've seen that, frankly, if you look at the chart for VNQ over the last 6 months. Active management, though, allows a manager to be selective, to go in and try and ride the wave for the sectors that COVID is perhaps helping. So think of working from home type of technology. So Zoom, Shopify, et cetera, Amazon, those are all encapsulated in REITs that capture the data space, data centers, shopping warehouses, cell phone towers. So those are specialized REIT sectors that an active manager can jump into now and perhaps ride up and take advantage of this current COVID environment.
The SEC approved semi-transparent ETFs in 2019. What will this allow REIT portfolio managers to do?
Well, as we just talked about, active management in these wrappers allows these managers to access and select individual sectors that they find interesting. And of course, being inside an ETF wrapper, investors will benefit from the features of an ETF. For example, lower cost, tax efficiency, and of course, intraday liquidity. But what's also very interesting is that these wrappers are designed to hide the portfolio manager's secret sauce, what he or she is doing in the marketplace. They don't want to telegraph to the whole market that they're buying a certain sector, because then folks can free ride and jump on and just follow their strategy. So these wrappers are designed to give benefits of an ETF, but at the same time, hide what the manager is doing from predatory third parties.
And there, as you mentioned before, there are different types of semi-transparent active ETF wrappers. Tell us about the Blue Tractor wrapper and what that's designed to do.
Sure, exactly. Well, as you can see from the slide in front of me, there's a bunch of features of the Blue Tractor ETF wrapper, which we call Shielded Alpha, which we're very excited about. This was approved in late 2019 by the SEC. It's just an ETF wrapper, so all the benefits of an ETF versus a mutual fund, the lower cost, the tax efficiency, the exchange trading come from this wrapper. Also a cloud-based solution, so it's very turnkey and simple to use operationally for asset managers. We also have some very interesting cloud-based tools that allow the manager to adjust the creation basket in this ETF to enhance cost and tax efficiency. But I want to focus on the transparency of this wrapper. The sector is often called semi or non-transparent, but the Blue Tractor wrapper actually is highly transparent. And what do I mean by that? I mean in the daily creation basket that's published to the marketplace, every security in the actual portfolio will be in the ETF. There's no decoys, there's no omissions, there's no use of cash to hide securities. So for example, let's just say an ETF, a REIT, active REIT manager wanted to buy, was interested in the self-storage section. Well, they would go, of course, and buy PSA, Public Storage of America. That would be in their portfolio. That would also be in their creation basket. Let's say they wanted a smaller cap name in the storage space, like Global Self Storage, SCLF. That would also be in the creation basket as well as their portfolio. So that way, market makers know the risks that they're exposed to. They see the names in the portfolio, and they can hedge appropriately. And so by hedging appropriately, they can keep prices very tight, spreads very tight in all market conditions. And that's very important when active managers play in the small cap space. Some of our competing wrappers, because they're less transparent, they're more non-transparent. Market makers won't know the exposure they have to these small cap securities in any detail. When they don't know their risks, spreads will widen. And that means in high volatility or crazy markets like we had today, investors may not get the best experience when they buy and sell because spreads won't be as tight as they could be with the Blue Tractor wrapper. Let me just finish up, Jill, by just saying that we're absolutely delighted that one of the first active ETFs powered by Blue Tractor will launch on the Nasdaq exchange in Q1, and it will be an active REIT strategy right up with Alps Advisors. So we're very, very excited about that. And thank you for letting me talk about that today.
Yeah, that's fantastic. Congratulations on that, Simon. Great to see you. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.